Here is a business accelerating in plain sight. Trailing revenue of $33.9 billion, net margins near 46%, returns on invested capital above 50% and still climbing. And yet the shares have been marked down all year on a single fear. That fear? That the card rails themselves are being routed around. Instant bank-to-bank payments, open banking, a rumoured consortium buying its way past interchange. The market is pricing a future the current numbers do not yet show. So is this derating prescient or premature? That is the whole question. By the end, you will know exactly how Mastercard makes its money, why its returns on capital cite among the highest in public markets, how management funnels cash back to shareholders, and whether a stock trading below its fair value range is a bargain or a warning worth heeding. Mastercard is plumbing. It authorises, clears and settles transactions between the banks that issue cards and the merchants that accept them. It touches none of the money and carries almost no credit risk. It simply charges a fraction of a cent on every dollar that crosses its rails. Two engines drive the company. The payment network, the classic switching business, generated $19.5 billion last year, nearly 60% of revenue. Value-added services and solutions, everything layered on top, produced $13.3 billion. The split matters more than it first appears. Why does it matter? Because value-added services are compounding at roughly double the network's pace. Recent disclosures put that segment near 18% growth against switched transactions around 9%. That mix shift is the mechanical reason the top line has re-accelerated, even as core switching grows in high single digits. The growth record is the foundation everything rests on. Revenue climbed from $18.9 billion in fiscal 2021 to $32.8 billion in fiscal 2025, a compound rate near 15%. At that scale, that pace is rare. Most companies stall long before this size. Earnings grew even faster. Diluted earnings per share rose from $8.76 to $16.52, and read $17.28 on a trailing basis, a compound rate above 17%. That gap between revenue and earnings growth is no accident. It is margins plus a shrinking share count. The margins tell a story of quiet strength. Operating leverage shows one level up, where the operating margin has widened from about 57% to nearly 59% trailing. Incremental revenue drops through a largely fixed cost network. This business improves its economics as it scales. Here is where the quality becomes almost hard to believe. Return on invested capital rose from 33.6% in 2021 to 51.9% trailing. Against a cost of capital near 7 to 8%, Mastercard earns roughly 6 times what its capital costs, and the gap is widening. The cash backs it all up. Free cash flow reached $17.7 billion trailing, converting at more than 100% of net income. Capital expenditure was just under $500 million, below 1.5% of revenue. This is a toll road with the road already built. What about the debt? A debt-to-equity ratio near 3 looks alarming until you see the equity base is tiny by design, hollowed out by buybacks. The number that matters is leverage against earnings. Net debt sits at just half of annual EBITDA. Trivial. Interest coverage runs near 28 times. Cash returns follow a clear hierarchy, and buybacks dominate. Share repurchases climbed from $5.9 billion in 2021 to $11.7 billion in fiscal 2025. The first quarter of 2026 alone retired roughly $4 billion. This is the engine behind per-share value. That spending has a visible effect. Diluted shares outstanding fell from 992 million in 2021 to about 901 million, a reduction near 9.5% in 4 years. A growing profit pool concentrated across fewer shares. That is manufactured earnings per share growth. The dividend is deliberately modest but rising fast. The payout per share grew from $1.76 in 2021 to $3.37 trailing, nearly doubling in 4 years. Yet it consumes only about 18% of earnings. The yield near 0.6% will never be the reason to own this. Acquisitions are the wild card, and they connect straight to the thesis. The company recently spent about $1.8 billion on a stablecoin orchestrator while weighing a sale of its VocaLink real-time payments unit. These are not capacity purchases. They are bets on where payments settle next. Why do these returns persist? A network effect close to textbook. Merchants accept Mastercard because billions carry it. Cardholders carry it because millions of merchants accept it. Neither side defects, and no third network can bootstrap both at once. Globally, card rails are effectively a two-firm structure. The resilience of margins is the corroborating evidence. Across 5 years, net margins never strayed more than 1.5 points from 45%. A business without pricing power would show compression as it grew. Mastercard shows the opposite. That is a wide moat by any measure. Still ahead, the fair value math and the single risk that could break this. But the backdrop matters first. United States inflation reportedly hit a 3-year high in mid-2026, running near 4%. For a company earning on transaction volume, consumer spending is the line to watch. The consumer data is sending mixed signals. Revolving credit contracted at nearly a 5% annual rate in May, hinting at stress, even as one major spending tracker showed card volumes up 6.3% in June. Gross dollar volume is where any pullback surfaces first. 2 live developments sharpen the disintermediation fear. A consortium of large United States banks is reportedly weighing a roughly $15 billion move for Fiserv's debit networks, explicitly to route around interchange caps. Neither that nor the VocaLink sale is yet confirmed, but both are real signals. Where does the stock actually sit? Near the middle of its 52-week band, between $471 and $599, recently slipping below its 200-day moving average. The market has spent the year discounting the fear rather than the accelerating financials. The clearest near-term test is concrete. Second quarter results are due July 30th, with consensus looking for roughly $4.75 in earnings per share. A beat driven by value-added services, strength and healthy cross-border volume would challenge the bear narrative directly. All that quality has a price. A discounted cash flow starting from $17.7 billion of free cash flow, growing about 12% and easing to 9%, with a 4% terminal rate and an 8% discount rate, lands near $675 per share. Tighten those inputs, and it falls toward $493. Mastercard has commanded a premium multiple its entire history, between 34 and 41 times earnings, compressing to about 31 times today. Applying a more conservative 28 to 34 times band to next year's consensus earnings yields roughly $550 to $670. Does today's price demand more than the street already expects? Consensus sees earnings per share climbing from $16.55 to $19.68 next year, $22.83 the year after, toward 30 by 2029, a compound rate near 16%. The fair value assumptions ask for less than that, not more. Blend the 3 models, and a fair value range emerges near $515 to $665, centered around $590. Against a price near $536, the stock sits roughly 10% below that midpoint. It is priced as if the forecast growth might not arrive. What would prove the fear right? Structural disintermediation would show first in the payment network, switched transaction growth and gross dollar volume slowing toward low single digits, then cross-border softening. The evidence to watch is specific. Network revenue growth breaking below mid-single digits for consecutive quarters. Until then, the thesis holds. There is a darker reading worth confronting. That stablecoin deal and the willingness to sell payments infrastructure could mean management is buying its way onto rails, it fears. Yet the upside is real too. If value-added services stay network agnostic, Mastercard monetizes the very rails meant to displace it. So, prescient or premature? On the weight of the evidence, Mastercard looks modestly attractive rather than expensive. Returns above 50% are rising, cash conversion beats reported profit, and the shares sit about 10% below a fair value near 590, discounting a decline that has not touched a single reported line. This is an educational analysis, not investment advice. Every figure comes from public filings and consensus estimates, and the future rarely matches any model precisely. Do your own research before making any decision. If this breakdown helped, subscribe and tell us in the comments which stock we should analyze next. The biggest risk to the whole thesis is that the market is early, not wrong, so watch that network growth number. Thank you very much for watching, and we'll see you next time.